Bhanu Baweja is UBS Global Head of Emerging Fixed Income, Currency and Credit Strategy for Emerging Markets, joins me in the studio now. And so your position on all of this, well, even before the death of Kim Jong-il, Bhanu, has been long $1. So you're selling emerging market currencies like the won. Why is that?
I certainly am, because all the emerging markets don't have a major balance sheet problem, which Europe does, and which to a certain extent the US does as well. They do have a very severe income statement problem. They are going through a very intense cyclical slowdown. Exports, if you're lucky, are going to be flat. More likely they're going to be negative for a while. That's not a situation in which Asian currencies appreciate. So we have been long $1 for quite a while. Obviously, $1 has increased further on the back of this, and I do expect that political uncertainty will give us a few extra percentage points on that trade. I do want to state, however, that we do not expect any near-term escalation of security conflict. Okay. I do think it nonetheless makes sense to be short the won. We do think that the stock markets can suffer further, but that's purely an economic call. In security terms, there will be a higher risk premium, but we don't expect this to go to hell.
All right, so that's good. You make a clear distinction there between the geopolitical developments. You're not expecting much of an impact on the security of the region from Kim Jong-il's death, but your trade is essentially based on the economic fundamentals. So how long is this slowdown likely to last? When might you change this trade?
Well, the genesis of all volatility right now really rests here in Europe, right, in Berlin, in Frankfurt, and in Paris. I do think that in Q1 we will see a further escalation of the problems in Europe, quite simply because there's a huge amount of refinancing risk coming through. So I do not expect the markets to really bottom out, or global PMIs, which I watch very closely, to bottom out before the end of Q1, early Q2.
You're saying to sell the euro versus emerging market currencies. And I guess you've just explained the reason for that. Why? What do you think might actually perhaps cap euro losses going forward next year? What if we were to see, I don't know, ECB intervention, for example?
Well, first, quick clarification. Selling the euro versus emerging market currencies is a 12-month call, right? That's something that we're very comfortable on a 12-month basis, especially where emerging market currencies have been sold off extremely largely, right? So Mexican peso, Indian rupee, Brazilian real, and to some extent the Turkish lira, which now begin to offer you very strong carry gains as well. So you're making about 8 to 10% purely on the carry as well, right? So these are places where on a 12-month view, we are happy to go long in emerging markets versus the euro. What could cap European losses is if Europe the euro-dollar declines sharply, and then on the back of that you see joint intervention, and I want to stress joint intervention from the ECB, from the BOJ and the Fed. If we do see sudden losses on euro-dollar, you could certainly see them coming in and supporting that. The other thing which I think has already slowed down losses in euro, I mean, many people would have thought euro-dollar by this time would be at 110 or perhaps parity against the dollar, which hasn't happened.
That's what John Taylor is calling for. He's been calling for that all year.
Indeed, and the point is that that hasn't happened. Why hasn't that happened? Because quite a large chunk of Asia, in particular the Middle East, I think, takes their dollars and then recycles them into euro, and that clearly slows down the pace of euro depreciation. So that also helps the euro in this case.
All right. Now, what about the yen-US dollar then? Is that going to continue to benefit from rising aversion to risk?
I personally think it is. I do think the trade in yen is going to be selling volatility, in that we don't expect the yen to go very aggressively in either direction. But if I had to take a call on which direction the yen is more likely to go, I would say that over the next 6 months it's more likely to go stronger, just because of the kind of financial backdrop I mentioned. I do think in that situation emerging markets will come under pressure, and you will find that the Japanese institutions are under greater pressure to bring back money home, which will lend support to the Japanese yen.
You're bullish on the Indian rupee. Again, this is over the next 12 months. Why is that, given the currency has fallen some? We were just saying over the past 6 months, some 20%.
Yes, in the forward space as well, it's fallen more. So you are, if you go long the rupee today on a 12-month view, you make significant amount of carry gains as well. The growth inflation mix in India presently is actually pretty bad. My point is that that's quite nearly in the price. You're at around 52.5. I think at around 55, you will see dollar rupee topping out, and euro rupee could have topped out already. The reason for that is that India doesn't have a very large current account deficit. Sure, it has a deficit, doesn't have a very large current account deficit. The stock market has already underperformed. I do think there's a little more underperformance coming through in the next few weeks and months, but we do think inflation comes off from out here, which means RBI will be able to accommodate growth through looser monetary policy, which will help sentiment out there. I also think that the weakness in the rupee has been because of bunching of some short-term debt payments, which we do not expect will persist over the next 12 months. So we do think that around 55 is a good time to start locking in forward dollar selling and locking in the carry as well.
Very briefly, Bhanu, just give me your top trade, your top play in emerging markets, given that you do have a situation where European debt crisis is really putting downward pressure on these currencies.
Very much so. For now, I'm selling small open economy currencies. It's a very simple trade, looking for an economic slowdown, long dollar won, long euro check, and looking for these to go high quite simply because economic growth is going to be very slow. Income statement problem, not a balance sheet problem.